Hey everybody, just waiting for Michael to join us. Thanks for joining early. I'll be right back. Hey Michael, just made you co-host so you can chat. How are you doing?
How are you?
I'm good.
Exciting webinar. You got a lot of people showing up.
Yes,
Great job.
got 13 people already come a few minutes early. We're live right now.
Fantastic.
Just give people a few minutes. I know we're gonna have a very good conversation. I have lots of questions. I'm sure the investors have lots of questions, and you have lots of answers. And I know our last Fireside chat went very long. I'm looking forward to it. I got stretched out, so I think it's it's stamina.
Is what?
If I can stand on for probably 2 hours. I don't know. Hopefully it's not 2 hours, but let's see.
As long as we need, all right?
Yep. I think lots of curious minds want to know what's going on.
Well, we will fill them in. Yeah, a lot is happening this year, as you know. So, realistically, this is our last year. Anything above a 2.5.
Yeah, it's a big statement. And I think it's lots of definitely a lot of urgency. I think Ryan was telling me, he feels like people calling December 30th might not be the right time.
No, and our ears in the ground and a lot of meetings on both the environmental company side as well as Green Rock as a sponsor. They want the EARN Act to pass. We weren't sure really at the beginning of this week if they could wrangle everything together, but from what we hear now, the EARN Act is going to pass. We're just a tiny little sliver in there, or a footnote, but we're going to get inserted in there with retroactivity removed. And that's how it's been negotiated. And so when it passes, this is going to pass at a 2.5. And the anticipation is it passes this year.
That's certainly gonna change the economics. It's gonna certainly change the economics.
Oh yeah, big time.
All right, hey guys, we're just 2 minutes to the hour. We'll probably start on time today. This is being recorded. I know there's lots of people who are attending. We had 175 people register. We'll send the recording to those who registered. So if you guys miss anything in the beginning or miss anything in, because we're gonna go try to answer as many questions as possible in great detail, or Michael will be. Don't worry, you'll get a recording for those who register. So Michael, I just launched my latest Bitcoin mining fund.
I saw that.
I just recorded a webinar an hour ago.
Did you?
Yeah. So I'm glad I'm not talking a lot this time. It's you.
How do you feel about the new fund?
I'm very excited.
Yeah.
Yeah.
Great job. You got terrific equipment for a very cheap price and locked in energy rates.
Yeah, there's apparently there's several Bitcoin miners, big ones on my mailing list, and they asked me about it afterwards. So interesting.
Yeah, very exciting.
Right. All right, guys, it's 6 o'clock. I know we're gonna have a lot more people come in, but just to be respectful of Michael's time, lots of lots of context, lots of information to share. And this is going to be a fireside chat where Michael will be mostly talking, and he has a lot of great information. But I want you guys to be as interactive as possible. So use the Q&A. Feel free to ask questions now. I will try to filter the questions, summarize them, put them together if there's any repeats, and interject Michael and ask Michael those questions as well as my own questions. But with so that's just housekeeping items. So just use the Q&A. With that, I'm going to start introductions and introduce myself, and then you, Michael. For those who don't know, my name is Eng Tang with Tozy Capital. And last year we had several dozen, 48 plus investors, I think, invest in land conservation. I think it's a great, it has been historically a great tax advantage opportunity, as well as preserving the environment. And Michael has been a really great partner in knowledge and an expert in this field. Michael, could you introduce yourself?
Hey everyone, good evening. Thanks for joining us. Michael Hazen with Terra Green Rock, and based out of San Diego, just south of Eng. Welcome you all to this evening's fireside chat. Again, as Eng has said, please ask questions. This is an open discussion, question and answers. Want to keep it pretty informal that way. We have a lot of information to be fleshed out. Any questions, please, again, raise your hand. Great to be here this evening.
So let's start with some basics. Let's assume no one knows what an easement is. As simply as possible, could you explain what a land conservation easement is?
That simplest explanation, 1980, Congress passes a law, which is still in the IRS code today under section 170H. It'll be 42 years old this December, to incentivize private land donation for conservation and preservation. In a nutshell, this is the only mechanism the federal government has, and then the states, for geographical lie of the land, is the only way the federal government has to conserve land today. Approximately 2.2 million acres a year are developed, that's 6,000 acres a day. And with no offset, no mitigation, it will all be gone at some point. So we go back to Teddy Roosevelt and the Antiquities Act, setting aside land for landmarks, really the federal government's first initial push into land conservation, utilizing federal funds. Fast forward to the late 30s, federal funding to the states for their own conservation and preservation purposes and endeavors. Again, 1980, passage of the law that's still current today. And that allows for, if the shareholders vote to conserve the land within the partnership, it allows for a 50% reduction to your adjusted gross income. And additionally, 16 years. So this tax year, plus an additional 15 years to utilize unused portion of that deduction. It's carried forward on Schedule A. It's a non-cash charitable contribution donation for real estate. And again, that's a 50% reduction to your adjusted gross income, and it's 15 additional years to include the current tax year to utilize that deduction.
So as a real estate investor, and I'm sure many of you guys on the call are, we use deductions to offset gains, and typically we do it at a 1-to-1 rate. Depreciation is great, and we use it to essentially offset any current gains and defer to the future. And then when we take leverage, the bank doesn't take any participate in that participation, but usually we can't take too much leverage, and it's still 1-to-1. What I find interesting and fascinating with land conservation is there multiple impact. And just speaking from personal experience, speaking for Michael, the ROI, or sort of the tax return ROI, is so significant, especially if you're living in California or a high tax state, because it does apply to state taxes historically. So if you're making, for example, $1 million, you can take $500,000 off your AGI. And this is AGI, not passive gains, K1 gains, which, if I send you a K1, which I send thousands of K1s, lots of them have losses, paper losses on them. You couldn't take that against your active income. And I know many of you guys are, working at Apple or looking at, other companies that have very high paying jobs. it's very hard to get out of, not get out of reducing your tax burden. And so I find land use easement as historically one of the best ways to do that. Just setting some context of why I'm excited about it. And so I think, I think we can go into economics of that, but I think it's kind of makes sense, right? Like if you're able to donate, first of all, you get really great tax benefits. But if you're donating at 1-to-1 ratio, which is what most charitable contributions do, you're only getting what your benefit at the tax rate, so 37, 35%. And now with a multiple, you're essentially multiplying it. So of course, half your AGI. So what that means is if you donate, in a land acquisition easement, or I'm sure Michael can specify what that specifically means. You would actually get more. You could get more than 50% AGI, and you can use that to spend the loss for the future. So what's going on now with easements? I know you started in top of the hour talking about this might be the last year. What does that mean?
So for many years, the syndicated conservation easement partnership sponsors, taxpayers have been targeted through audits at the partnership level, threats, accusations, etc. And we have been going through the courts and utilizing that venue. We have judicial precedent now in the 11th Circuit, very, very solid judicial precedent in favor of the taxpayer and the environment. So judicially and congressionally, everything has suggested that if the sponsor has done a good job, follow the law, cross T's, dotted I's, and the taxpayer has filed their return with all the attendant documents, the appraisal and baseline report, K1, etc., that under this law, which are lawful deductions, the taxpayer has been targeted through, again, threat of audit. And the audit comes at the partnership level. We put a lot of money aside knowing that the anticipation is, the expectation is that every single partnership, every syndicated partnership in conservation easements will be audited. That's your expectation going in. And so what we look for is judicial precedent. How do the courts feel about this law? And so when I say we have the judicial precedent, we have very strong case law that supports the law as intended by Congress. So we know we're going to go through these audits. Like I said, we put a lot of money aside, understanding that this is the protocol. And for years, the attention has been on the syndicated transactions, like I said. So there's been 3 parts to a proposed rule change, and it's been pretty consistent throughout the years. The first one is to cap the multiple at 2.5 times, which simply nullifies, as Angus said, you put $1 in, $1 out. There's really no reason to make that investment. Just invest in other things. The second part of which we have vehemently stood up and contested and made sure that the rest of Congress understands is retroactivity. What they've been presenting as good for the country is to undo all the lawful deductions taken since 2016. This is when syndicated conservation easements were made listed transactions by the IRS, which simply means they're quote unquote tax shelters. That requires additional paperwork to be sent in with your tax return stating that you have participated in a listed transaction. Doesn't mean you've done anything unlawfully, just as a designation by the IRS, they want to know that you have participated in these things. So retroactivity is not only really bad for the country, it's unconstitutional. You can't change a law and then take that adjustment or that rule change and go back in time and apply it. It's anything moving forward from that date typically is now subject to the rule change, the new law. And so what they wanted to do is go back in time. And we have again stood up, spent a lot of time with members of Congress. We work with environmental groups who take a lot of meetings in Washington, D.C. to make sure that the rest of Congress understands that this is a very, very bad thing to pass retroactivity, because that applies to any law. It can say it targets this, but once that happens, that's any law can be changed and applied, the rule change retroactively. So Senate Finance Committee met about 6 weeks ago and voted 23-5 in favor of the proposed rule change. Again, first part is the capping of the multiple at 2.5 times, nullifying the investment, essentially nullifying the industry. The second part was retroactivity. That has since been removed. So retroactivity is no longer a thing. It is moving forward as negotiated. What I was speaking with Eng about earlier, we anticipate it coming and being inserted in the EARN Act, of which this week we come to understand that more than likely it will pass this year. It's a very large piece of legislation, of which we're a very tiny sliver. Things like this get slid into these very large pieces of legislation that has bipartisan support. And so we anticipate post midterm elections that this will be wrangled to a point where everybody agrees to the terms and it's going to pass. And when that happens, this law will pass as well. So the language proposed legislation is moving forward, simply means that when that bill is executed, the new law, the 2.5 times multiple, kicks into effect, and we're subject to that.
That's a great legal explanation of it. And I know this an investor asked, can you illustrate the example? I'm going to take this time to pull up a great model. Correct me if any of it is wrong. So I want to illustrate what has been the benefits of an easement, and then what happens when a multiple changes to 2.5. So bear with me, guys. So in this case, I just want to highlight that this AGI, adjusted gross income, is $500,000. I met jointly, California. I believe I have the correct tax rate. So very high. Yes, I know. Why do I live here? So why do you live here? 5. Well, because we do easements today. So 5 is some historically I've seen as a multiple. What that means is you get a 5 times benefit on your investment. So in this case, someone puts $50,000, they get a $250,000 AGI benefit. So that offsets 50% of their AGI. And on their tax rate of that, they would save $107,000 based on the tax rates without any other information, and essentially would make $57,000 profit or saved tax, and that would essentially be 114% return. And it's one of those things where if you make more money, you actually get, it's more beneficial. I know there's been news articles of Donald Trump donating his golf course or something like that. So like $1 million, you put $100,000, $500,000, because we're in a progressive tax system here. So 124% return. And so that's on a 5 multiple. So what happens when we do 2.5? It's even worth it at 2.5. So at 2.5, you essentially would have to invest $200,000, not $100,000, to get the same $500,000 deduction. And still, this is sort of like, you're in California, so if you're in Texas and maybe the returns aren't as good, so you're still making money, but it's I think if I should tell you invest in our Bitcoin mining fund, our returns would be higher. But if you're like in Texas or something, I don't know how it changes, but Texas would likely be a not positive return. Yeah, you would be losing money. You still be saving the environment, helping people out. It's a great thing. So just from that perspective, I think that highlights sort of why it's been really great at a 5 multiple, and sometimes even a 4 multiple, and less desirable at 2.5 multiple. Thus, this EARN Act provision that it's going to likely, put a pause to, or put an economic pause to syndicated partnerships. Did I explain that right, Michael?
You did, and I don't know if pause or complete stopping of what we'll see moving forward. There's discussions, and this is purely hearsay, of anything less than a 4 multiple may be palatable to all parties at the table, but we'll see. The majority of the land is conserved through family offices. So Zhang said, Donald Trump, Bill Gates, Ted Turner, Bush's Quails, etc. These individuals, these family offices have large land holdings. So the majority of the land is conserved. Again, this law was passed in 1980. This is well before the partnership rules allowed syndicated partnerships to participate in this, as well as any other partnership. So if you have the land, you're a very wealthy person, you can do this on your own land without syndicating. The third part of the proposed rule change, by the way, is that the family offices are excluded. This only applies to you and me, the lowly millionaires, while the billionaires continue on with their law. So, and when I speak about there's been this push to change the rules, this is coming from a very small select group of Congress folks. Mike Thompson out of California, Daines out of Montana, Debbie Stabenow. These folks are lobbying on behalf of very wealthy constituents, again, who just don't like us in their law. So when I say this is going to pass this year, I'm pretty much stating that this has been negotiated. This wouldn't be presented otherwise as is. It's been negotiated as a 2.5 and moving forward. Again, simply that when this bill is executed, which we anticipated being in the EARN Act, it will go into effect.
So I think it certainly is very urgent. Basically, if you're ever thinking about doing it or you've done it in the past and you're comfortable with the risk or you're comfortable with the process, which Michael can talk through all that, this is the year to do it. And I don't think next year makes sense based on what you referred to. And so, would it make sense to, get a fairly large multiple that even trumps your 50% AGI? Like store it as a huge bank of losses. Is it like if I was making $1 million a year, should I, and I have cash to do so, would it make sense to like stock up on this 5x multiple this year?
That's a question.
Huh? Yeah, that's a question to you.
Yeah, so knowing that the deduction is preserved, again, moving forward, so anything prior to that legislation passing will be grandfathered in with current law. The current law, again, allows for a 50% reduction to taxable income. It can exceed a 2.5 multiple, and you have 15 additional tax years to use any unused portion of that deduction. It's carried forward on Schedule A. It can sit there. It's discretionary to the taxpayer. It does not have to equal 50% of your AGI. And you can skip a year. You can skip 2 years, depending on your tax situation or income situation. Obviously, most beneficial for the highest income tax bracket, marginal income tax bracket, high state income tax. Again, as Ang said, California, a lot of us are here. So the most income and the most tax state you're in. And so that's your greatest result. Again, you can have years that you foresee some vesting, stock options, capital gains. Obviously, the higher the income and the higher the marginal tax brackets, the greatest effect, as Ang is pointing out through this example. Yeah,
and previously had 30% for California state AGI limit. Is it 50% also?
It's been a great question, and we searched on both sides, yay to following the federal standard, because the federal standard up to several years ago was 30% AGI reduction for real estate under the charitable donation, and 5-year carry forward. That was up to 15 years and 50%. We searched for any record in California legislature, any suits, any audit results. We couldn't find if the state, because it's up to the state to follow discretionarily whether they want to apply the new federal standard or stay with the old standard. And so I've been filing at 50%. My accountant has been filing at 50%. My clients have been filing at 50% for the state of California. So that's where I'm with that.
That's great. So, and one investor asked, how do we make money in this? So just to reillustrate, if you're investing $50,000 today or December, which you shouldn't because it might not be available in December, and we can talk to the timing of this thing. If you're investing today, you would essentially effectively get a tax refund unless you're not paying taxes for the rest of the year, which might be a good idea. I'm not sure exactly how that worked. You can file for exempt status. Since it's sort of half the year, you would not pay taxes the rest of the year, knowing that your AGI is significantly less because of this deduction that you receive on half your income. And so just to complete that train of thought, you would invest $50,000 in this case if you make $500,000, and in effect you get $120,000 back in tax savings, giving you $70,000 in net profit based on the tax and the return of taxes. I think another great question is, what's the minimum AGI to participate? Michael, as I know, there's no minimum AGI to participate, but there's a economical reason to participate at a much higher level. If the AGI is low, it might not make sense at all, correct?
Yeah, so this is an accredited investor offering, which simply means that your AGI must exceed $200,000 per year if you're single, filing single, and if you're married, filing jointly, it's to be $300,000, or disjunctive test, or $1 million net worth, which does not include the equity in your private residence. So as long as you meet the accredited investor standard, then this is an option. If you want to go back real quick, Hank, to the calculator.
Yep.
Even at, say, a $200,000 income, you want to then go, because you're going to be in the 32 Fed, 13.3 state, it still works out to about 126%. First year net rate of return, as Egg stated, this is after tax, right? And it's always been, again, and I'll preface with, if the shareholders vote, a majority of the shareholders vote to conserve the land, there's 3 options under the law. The partnership does not tell the partners what to do with the land. The partnership or the partners votes, simple majority of 50.1%, simple majority of outstanding shares votes to either preserve the land, this is in no particular order, preserve the land, do nothing by it, preserve it, sit on it, and organically, perhaps it appreciates in the future, we sell it at a profit, and we all participate on the capital event upon sale. The second is to develop the land. If a majority of the shareholders tell us to develop it, we will develop it. This is a rock mine, so we'll be mining for infrastructure materials, gravel, granite, limestone, or sand. The third option is to conserve it, and that's through the conservation easement. If in fact the shareholders vote to do that, then this is where this conversation is applicable. So when we're looking at the first year return, again, how do you make money on this? As they stated, if you're W-2, you can, mess around with your exemptions. I'm W-2'd as well as 1099. So I just do my quarterlies and I adjust it knowing that I'm going to reduce my tax bill in half. Thereby, I just don't send the federal government, the state government, all the money that I know that I'll be getting back by filing my return with this deduction.
That's exactly what I did my last year at Apple, making great money. And I know that I didn't want to wait for a tax refund. In fact, I'm actually still waiting for tax refund from 2020. So I should call the IRS on that and backed up. But essentially, starting in, I believe, like August or July, I went to my HR little thing portal and changed my tax filing size to exempt. And I was like amazed how much money I was making every month. It's like, wow, that's how much money I was paying taxes. And then the bonus season came in October, and I'm sure some of you guys are familiar with that. Like all that taxes I would have, that I didn't have to pay, it was like so much bigger. I was like, it's like I got 3 promotions. It was like amazing. So it's definitely, that's how I handled it, at least. And I do want to highlight that, if you're living in a tax state like Texas, I think you're just going to get a little bit less return, right? It's 35%. And so you're not going to get as high a return. And I'm happy to share this spreadsheet. Right, we live in a progressive tax rate. What we try to do as W-2 employees, when I was W-2 employee, we all try to reduce our pre-tax income, pre-tax income, because essentially putting in money in HSA, FSA, any of these, spending anything, you're essentially getting a 35% discount federal. If you're basically live in California, you're getting a 48% discount, and anything you pay pre-tax. So if you buy a computer, and you can deduct it against the AGI for some reason, that's essentially a 48% discount on your new MacBook. So it's an amazing deduction that if you're making a lot of money, if you're living in a high state tax rate. And of course, those who have that kind of money probably pay some great tax attorneys to figure out all this out. And that's the advice they've received. And I talked to many of them, and Michael is familiar with this as well.
Do you want to answer some of the questions?
Yes, yeah. So let's go through. One of the questions is the benefit only for 1 year? I think the answer you mentioned is it just carries over for 16 years, right?
Yep. So you have this tax year to use the deduction, subject to the 50% maximum reduction of your below the line AGI. So all your above the line deductions, to include depreciation, 401k, IRA contributions, pre-tax, anything that's going to reduce your above the line income, whatever is left, we can reduce that by 50%. If you invested 100,000 and you overshot your income, and say you only used 80,000 of that deduction, you'd have 20,000 in deductions carry forward, Schedule A, to utilize for the remaining 15 years.
Yeah. So if you're making like $1 million and your AGI limit is 500,000, you could put in $1 million and get a 5-time deduction, half 5 million. You'll only be able to lose 10% of that, but you're still reserved 4.5 million of losses, suspended losses, for those remaining years, and you can use it. I think, Michael, you said that you can choose to use it whenever you want. As it's obviously tax situation change every year. So really great piggy bank of losses to protect against future tax, high tax years, especially if you're have variable income where you might have an exit or the market's up and down.
Yeah, and we're always solving for the loss of development. If a majority of shareholders vote to conserve the land utilizing the conservation easement, the partnership will record a deed against title, forever extinguishing the development rights on that land. That is then transferred over to a nonprofit land trust that enforces the non-development of that land.
Yes.
So by extinguishing the development rights, what we're giving up are all future distributions, because as partners in the partnership that owns the land, if that land would have been developed, then you would be receiving your forward profits through distributions to the useful life of that project. If in fact the shareholders vote to not develop but to conserve, that land will never be developed. You'll never get your future profits or your distributions. All of that is calculated into what's called enterprise valuation, present value, future discounted cash flows of what that land would be worth fully developed. By giving up the development rights on that land, you are incurring a business loss, and that's what shows up on the K1, the first year.
Somebody asked, they have extra deductions from previous year, and they do another contribution this year. Am I able to choose to use the older leftover deductions before using the new one? Does it really matter? Is there any characteristics of vintage here? It's all just number, right?
Yeah, there's no distinction between tax years or offerings. It's on Schedule A. You can choose, again, discretionarily which to use and how much and when.
So, Michael, you mentioned the IRS wanted to change 3 things: the multiple to 2.5 limit, potentially 4 retroactivity, which is to remove. What was the 3rd thing?
And that came from Ashish. Hi, Ashish. The 3rd is the family offices are excluded. I think you also had a question about that. Does not apply to family offices. Okay,
so he does ask the following question: no cap on the family office. Okay, so how do we set up a family office? Should we talk about that? Will the new laws be effective immediately this year?
So the way this has been negotiated, this has been going on for quite some time. The way this has been negotiated, in order for certain members of Congress to sign off on it, is that moving forward, which simply means that once this bill is executed, anything past that date is going to be subject to the new rule. Well, sometimes laws will change, tax code mid-year, it'll be applicable for the entirety of the year going back to January 1. In this case, it has been negotiated moving forward.
And when's the moving forward date?
That's the discussion about the EARN Act. We anticipate it being inserted into that very large piece of bipartisan supported legislation. When that bill passes, we will be part of it as negotiated with the 2.5 multiple.
Speaking of the EARN Act, a student investor asks, or attendee asks, they have been trying to sneak in consular easement integrity provisions, cap on deductions for years into big legislation. What has changed this year that they think they can attach it to the EARN Act?
Again, there has been a push for the syndicated conservation easement companies to go away. This has been going on for more than a decade. So we've gone through a lot of judicial exercise, tax court, appeals court, 10+ years of litigation in these matters. We finally have resolution. We know how the courts feel. We know how Congress feels. And this is, again, the second piece of that proposed legislation has been their bargaining chip, it would seem. And so again, the first part of 2.5 multiple, that nullifies the investment, as Agnes showed you on that calculator. It's better if you're in a high income tax bracket, as well as in state income tax, subject to state income tax. If you're in a state that's subject to Fed and you have whatever you have as far as your income, it may or may not make sense at a 2.5. So the 2.5 has always been the point that would basically nullify the industry. The bargaining chip has been the retroactivity, and they haven't been able to get this passed. And so all this push, all these years to remove us from the equation, it's finally coming to a point of resolution. There's clarity, there's resolution. Both sides of the table are comfortable with this resolution. The sponsors are happy. Imagine undoing 6 years of lawful deduction statement across all sponsors and all investors. In addition, the environmental groups are on board because you're talking about thousands of deeds that would be nullified and millions of acres of land that would then become unprotected. And that is the goal and intention of Congress under this law for 42 years, has been to conserve and preserve the land. So you're basically undoing what Congress has set out to do and what sponsors in this industry, syndicated companies, have done according to law. So everybody is on board. There's no opposition. When we were standing up and really lobbying and making sure that everybody's eyeballs is on retroactivity, those eyeballs are on it. And so as negotiated, so moving forward, everybody gets a win, and we hopefully just ride quietly into the night. Big win for taxpayers. Like I like to tell my clients, if retroactivity was still on the table and we didn't think that it wasn't going to pass this year, we would be having a very different conversation, right? Because I ethically couldn't say this is a good investment, knowing that retroactivity more than likely is coming. Knowing that retroactivity has been discussed, knowing that it has been negotiated out of the proposed rule change that is going more than likely to be inserted in the EARN Act, is a really big win for the taxpayer and the environment.
And some who have asked, should I calculate? Yes, I will share it. Long-term capital gains bracket. Do you have a similar calculation? I think the long-term capital gains bracket would still be sort of an attachment to the AGI, correct?
Correct. Yeah, so long-term capital gain, obviously lesser result if in fact the land is conserved with the conservation easement. Just have to run a scenario just to see where your income, which more than likely is going to be taxed at a higher rate, and where your long-term capital gains and how that all blends. There's stacking, you can apply it however you want. If you want to apply it first to your highest income or the income highest bracket, and then start attaching or applying to the long-term capital gains.
And I know a lot of people are, some people are asking, like, is there a fund? We're not necessarily going to talk about the investment here, although we do have one, or Michael has one, not me. I just want to highlight that it is very immediate that this thing might happen anytime, well, when the EARN Act passes. So, but you talk about syndicated partnerships, I think that's a good terminology. Can you describe that a little bit?
Syndicated partnerships, we as individuals don't own the land, so we form a partnership which buys the land, and then we are partners in the partnership that own the land. So syndicated, we're outside the family office. The basic definition is there. They own the land. They're not going outside of the family to raise capital as investors. They own the land. They do the easement on their own.
And is this rule going to apply to non-syndicated partnerships?
So again, that's the family office discussion. If we create the point of distinction between syndicated and non-syndicated would be a family office. They own the land as an individual family. The third part is in part of Ashish's question is the third part of the proposed legislation is family offices are exempt from this. It does not.
To cut it by the 10-acre right across the road, put it like a development and conserve it, and then still get the multiple on that without
Yes.
caring. Okay.
Yes.
But to get, I buy some acres. Let me know this one parcel out individually, no syndication. So the multiple is still 5 this year. I think explain 5 is not always common or always assured, right?
I'm sorry, which one?
A multiple of 5. You keep talking about 5. Is that in my experience, I've seen sometimes higher, mostly slower, but still around 5-ish. Is that sort of the expectation of maybe like the next fund you're doing?
Yep. So I have not received the final PPM. That's the controlling document, the private placement memorandum. That's what's registered with the SEC as a registered security. Once I have my final PPM, which I anticipate early next week, that's when we'll start raising capital for this offering. I anticipate it's being somewhere around 5. I won't know that until I see the PPM. The multiple is a function of 2 numbers. Your numerator is enterprise valuation. That's what we discussed briefly a few minutes ago. So enterprise valuation is simply present value, future discounted cash flow of what that land would be worth if fully developed. So in this case, it's going to be a rock mine, gravel, granite, limestone, or sand. We know what's in the ground. We've done geology, hydrology, feasibility reports, engineering, floor samples, everything that goes into understanding what's in the ground, how much is there, what's its quality, and then understanding for feasibility, being able to deliver that into the public and the private markets. So what we're getting, I'm sorry, do you have a question?
No, good.
So what we're giving up is that all that future development. So that enterprise valuation is by law. This is how Congress has intended by rule. If I don't have a like sale, a similar sale down the road for me, an operational mine, what do I use? I use enterprise valuation, before and after valuation of the land, before the easement and then after the easement. So the after easement value is the developed value. That is your numerator. Your denominator is the capital raise. So a simple example, $40 million hypothetical valuation. I go out and raise $8 million in the offering. You divide the 8 with the 40, that's your 5. So when we're talking multiple, as Eng said, sometimes lower, sometimes higher. We come in, lots of data pushed, thousands of pages of outsourced third-party reports that we utilize the same companies that Martin Marietta, Vulcan Materials, Oldcastle Mining, the big publicly traded $billion-plus mining companies. We outsource the same companies that they utilize for their third-party reports. Because imagine Vulcan Materials deciding on which land to put their next mine site on. Well, they couldn't do that unless they understood what that land was worth. They wouldn't devote their energy, their resources to a piece of land that they didn't know what was under the ground. So this is standard in our industry. So what we're giving up is that $40 million of development divided by, again, the capital raise. If I want to adjust the multiple, just adjust the denominator. The numerator is set. We push all that data to 2 appraisal companies. They run their models on the data. This is not the fox guarding the hen house of data. This is managed data from outsourced third parties. Thousands of pages of science goes to 2 appraisal companies. They run their models. There's the lowest value. We have a desk appraisal done on that number. That's the value. So we have a value that's pretty much set in stone. And then you're dividing that by the capital raise. If I want to lower my multiple, all I got to do is raise my capital raise from 8 million to 10 million in this example to reach a 4 multiple. So whenever we're talking about the multiple, what we're talking about, did we arrive at the value conservatively, accurately, ethically, right? So it's all about the work that goes in prior to submitting to the appraisal companies to get the valuation.
Got it. So this new one's mining as well. Is the same operators before?
Yes. So if you are a current client, thank you very much. We couldn't do it without you. Thank you for your trust and support in our company. You have an investor portal. All of your tax documents, your K1, 8283, 8886, and then attendant documents, the appraisal baseline report, donation letter. Those attendant documents are required by law to be filed with return if you're filing a K1 seeking this deduction. All of those documents are stored electronically on your investor portal. We're utilizing the same software to display and populate all this year's tax documents as well. So your same login will access the same information for last year. Your distributions are all there, the quarterly statements for the distribution, and then every subsequent tax year, you'll find the same documents for that tax year.
We have a great question. What happens to initial investment? What is the holding time period? I mean, to jump in here, Michael, your example of 40/8, that 8 is initial investment, and what you do with that is you conserve it. You actually donate it. So but instead of getting a 1-to-1 multiple on donation deduction, you get 5-to-1. But what is the holding period time? Is it really constant that holding period time? Obviously, you get the tax deduction right away. What happens to the land? Who holds it afterwards?
Yep. So again, the partnership owns the land of which you're a part of the partnership. You have a ratable share ownership depending on your level of investment to the overall capital raise. So that's the strategic fund. Part of your investment is invested in a audit defense fund as well as a legal support fund. We put anywhere from $1.5 million and upwards in audit and legal reserves because we know we're going to go through an audit. That is the expectation. The partnership will go through the audit. It is illegal for the IRS and the state tax authorities to audit a K1 inside a personal tax return. They must audit the partnership. So at the partnership level, the tax matters partner will represent the partnership in the audits as well as any subsequent litigation if necessary to the tax court and the Court of Appeals. So whatever that window is, remember that the IRS has a 3-year look back to audit a personal or entity tax return post first date of filing of that return. As taxpayers, we have a 3-year look back to amend a return. So outside of that 3-year period, they usually get to the syndicated conservation companies right around year 2, month 6, 7, 8, right? And they say, hey, we're going to start this audit. We're under audit in 2018 and 19 programs. We hit that close to the 3-year mark. So we're being audited in those offerings. That's going to take a year plus. And then you have an appeals process at the IRS level. That can take another year. And then if we need to go to tax court because we don't like the result there, it's what I've heard is a 3-year wait for their docket. So you're already out multiple years. If in fact it doesn't come to a point of settlement at audit, to get an adjudicated result can be 7-10 years. So I would say conservatively 7 years that we're going to hold this investment, meaning that until we're through the audit window, we're going to keep the fund alive, meaning the audit reserves, the legal support fund. This is all in support and protection of the partnership. Once we're outside of that audit window, we have a settlement adjudicated result. We're then going to liquidate the audit reserve, any remaining portion of that, plus the legal reserve, the assets that we've invested, we'll liquidate those. That all comes back to our shareholders, our partners, any unused portion. In addition, we'll sell the land, excuse me, and don't anticipate a windfall on the land. Remember that if in fact this is conserved, that there are no development rights. And so no developer will ever pay us developer prices for that land. It's going to be the next door neighbor, a hunt club, an ATV group, a Boy Scout troop, someone who's going to buy the land at a greatly reduced price to use the land. So I believe in our hypothetical, we utilize a 3% residual value upon disposition of the land. Excuse me. That's what's remaining in the partnership. So you're going to be filing ongoing K1s for the distribution from the fund. Remember, a portion of your investment is invested in various investments, the private equity tranches, debt, hard real estate assets. And that all targets a 6% annualized return. So we send out quarterly distributions the year following that you make the investment. As we invest in the different vehicles, throwing off cash flow, we distribute those profits to our partners, and then you'll get a K1 every year for those distributions. So you have a filing requirement as long as this partnership stays open. At some point, we're going to want to stop that. And so we're going to sell the land again at the point of adjudicated result, settlement, and that will be the last asset in the partnership, and then we'll close the partnership.
Thanks for that. I know somebody asked if they should contact you. I would recommend contacting Ryan and put in the chat, mostly because I know Michael is very busy. He might not get to you, and Ryan nudges Michael a lot to ensure he gets all taken care of. If you need me to nudge Ryan, then we're all in trouble.
You bet.
So I really appreciate that contact with the IRS. And I think, it sounds like you can't get audited. It was illegal to audit inside a partnership return for K1 specifically. So it just be at the partner level. So at the individual level, I think relatively safe, I think.
And let me clarify that as well. You can receive a personal audit and they can look at that K1. What they should do, and I've heard from multiple investors, they've gone through recent audits, the state and the federal level. They're going to look for that K1. They see the K1, then they're going to look for the attendant documents, again, by law, and I just rattled those off, that are inside your investor portal. They're going to look for those documents. And when they see those documents, they should say, okay, next. Right? They're not going to judge the validity of the deduction, just procedurally that everything that should be with that K1 is inside that tax return. You can still be audited. The K1 can be looked at. They by law cannot go in and adjust the value or the number. They have to come to the partnership to do that.
Any thoughts on the increased money to the IRS now that Trump's gone, for audit enforcement, how that affects audits of prior partnerships going forward?
Again, the anticipation is that every single syndicated conservation program will be audited. It doesn't matter if there's one auditor, 1,000,001 auditor. Just know that going in. Will hiring more auditors increase their chance of wins in the courts that have already sided on the law as intended by Congress? I don't think so. They've done their best. Again, this fast forwards to why are we settling this year with a 2.5 multiple minus retroactivity? Because I feel as though they've run their course. They want us out of the law. It hasn't worked in the other venues, so this is the way they've negotiated us out of their law. So and I think there's a couple other questions there. That's how we're so confident. We've been watching this for years and years. We've been intimately involved in this industry. We know the discussions. We know the roller coaster the taxpayers have taken by following a lawful deduction. The IRS doesn't contest the validity of the deduction in the law. They just seemingly argue a very skewed version of it. And so we have clarity today. So that's why we anticipate, with no opposition from the sponsors, the development companies, as well as the environmental groups, because that's who's standing up in opposition. It wasn't in opposition to the 2.5 multiple, it was in opposition to the retroactivity, of which they've removed.
Someone asked, can we carry over the deductions just enough to lower our tax bracket over years, or do we have to use all 50%? I think you answered that earlier, but basically, if you make $500,000, you put $50,000, you get $250K deduction. You don't have to use all of it that year. You can use some of it next year, especially the top end. But of course, time value money, so IRR. So understand, you can bank the pretty big bucket of tax savings this year. Might be a great idea, but you might not want to use it for so long, because as an investor, you guys should know, time value money and opportunity costs of that investment. James asked, I have very limited income this year. Is it worth doing this year if the expectation of potentially returns next year? I think that's also same type of question. And I think, yes, it does apply for this year. Don't take your last year's AGI. Of course, last year's AGI is a good indicator of this year. You guys know best, especially if you're in W-2 job. It's very predictable year to year. Of course, for capital gains on taxes, on RSUs might be lower this year. So I think I'm happy to share the Excel sheet that I have. So everyone did their own analysis. Of course, it's just a simple tax return, understanding of tax code and how much you make and deductions of that. So somebody asked about the AGI this year. I guess answer that. Is it the only offset earned income? It's a great question. What about fellow passive income? AGI encompasses all of that, correct?
Yep, it's all income sources.
Yeah, just the gross income. And it's just that passive income or portfolio income, capital gains or stock trading are isolated in nature. Although it does add to the AGI, it's just that any tax losses, like selling Bitcoin at loss, might not affect your AGI or won't affect your earned income, won't affect your passive income, and same for the K1 losses. So what happens if the IRS audits a partnership and goes to multiple? I think we've talked about audits. I think, yeah, so basically the summary of what I'm hearing, Michael, is this is sort of a concession. The IRS is sort of saying, okay, we're going to stop it after this year. We're not going to pursue mostly the partnerships because you guys aren't going to be in opposition to this. Taxpayers going to win because there's less of this happening. We get more taxes. Is that the right summary?
So I think you just answered the question. So let me go back. That was let's see what it was.
Yeah, what happens
if
the
IRS audits partnership?
Yeah.
And rules of multiple would need to be changed from 5 to 2.5. So that means all the investments basically gone. Remember, the first step of the process is the audit. If we don't like the result of the audit, us being the tax matters part of the partnership, we then appeal that with the IRS appellate level division. If we don't like the result there, we become the plaintiff and sue the government in tax court. We don't like the adjudicated result there. It's appealed to the highest court in the circuit, 11th Circuit Court of Appeals, that's Alabama, Georgia, and Florida, and then that would be the result. So the IRS typically, guys, so puts zeros on all of the audit results. They give zero value to the land. This is a protocol they've followed for many years. It basically forces the tax matters partner to litigate. And there's a lot of partnerships out there that put no money aside for audit and legal reserves. And I have no idea how well they did their due diligence, which companies they used for outsourced data, how conservative they were on the performance projections, what was it included or excluded when deriving the enterprise valuation. It's like any other product, good or service. Make sure you know who you're working with, especially in this industry. Make sure you're aligning with a company that is ethical, that's conservative, that doesn't cut corners in any way, shape, or form, and puts a lot of money aside for the partnership's benefit for audit and legal activity. So if in fact the courts adjudicate the reduction to the deduction, all deficiencies will be handled at the partnership level, simply meaning that any monies that remain from the audit and legal reserves will go to pay that deficiency on behalf of the partnership. Anything that's left over would flow through an amended return, amended K1, amended return, and that would be done with your accountant down the road.
So when will we know when the EARN Act does pass?
And let me just follow it from Senate. How do we handle and defend the multiple? We do really great work along the way. We don't cut corners. We work with very, very solid entities that do this work in the industry. We cross T's, dot I's. We follow letter of law. And then we go through the procedural aspects of going through audits and necessarily going and litigating. So this is what we're getting into. Again, I highlight the IRS has historically not liked these, and they have pursued the partnerships. And so anticipate that this partnership is going to receive a partnership level audit. And we're going to go through that audit, and we're going to defend our multiple, our valuation, our work, again, aggressively, because we know what goes into these and we know the work that we've done.
That's great. So I was reading the last news was July 22nd. We got advanced to the Senate. What's your expected timing? When would we know when it passes?
Watch the news, and when they basically said, yep, everybody's agreed to the EARN Act provisions and everybody's happy, everybody got their stuff that they wanted, anticipate that day that they vote on the act, that this will be included in that. So all I can say is, you know what I know, it's all basically hearsay at this point. It could happen tomorrow. We don't anticipate it happening tomorrow. We anticipate it happening after the midterm elections. So sometime November. If it doesn't happen this year, I can't say guarantee, my feelings would be that they would get it done as early as possible in 2023, nullifying any investments for 2023. Again, making 2022 essentially the final year in the current iteration of any multiple in excess of 2.5 from the date that bill is executed. So if it doesn't happen this year, we'll have the timeline of more than likely end of December to make these investments. If it happens before that, that's our timeline. If it happens next year, that's our timeline. So it's in essence, whenever this thing passes, we're going to be included in it.
A very interesting question about application to timberland, which really has low taxes and land management if one doesn't develop it. I don't think that's as applicable, right? Because it's really developing something, economic value, whatever the tax, like if it's option zone or low tax land, I'm unsure. Is there any particular thing to answer there?
So everything at the land level, the partnership level, if you're talking about taxes, tax breaks, incentives, subsidies that approach, say, timberland, everything would be baked into the enterprise valuation. Again, if there's tax credits associated with timberland, that would be looked at, because what you're talking about is not harvesting the timber, right? Just remaining as is. So all the tax credits and any subsidies, anything that would be attached with that sector, specific sector, would show up in enterprise valuation. Again, this law is applicable to highest and best use of the land. It doesn't have to be the highest best use, that it's feasible. A silly example that I give, would I feasibly develop a golf course in the middle of the desert that's 100 miles away from Las Vegas with no road, no power? And the answer is no, I wouldn't. So a lot goes into feasibility. And feasibility simply means if this sector of real estate and this parcel of land is feasible to utilize in the industry or market for, say, for rocks, is there a road to the property? Or is there rail, or is there water? Can I move material off the mine site and deliver it into the public and private markets cost efficiently? So these are all points of discussion when you're looking at feasibility.
So someone had land and access to power and could put a Bitcoin mining, something to think about. So family office, guys, let me know who was in. Okay, we're 2 minutes at the end of the hour, but we're going to continue with Michael, if you're okay with that.
Absolutely.
We have 12 more questions. Feel free to continue. This is, to make sure everybody's questions are answered. Of course.
Yeah, great questions. So thanks, guys.
Yeah. So what is the minimum I would have to invest in order to earn the full 50% of AGI discount?
So the law is specific to 50% AGI reduction. That is irrespective of the investment amount. So yeah, you can invest $100,000 against a, this is hypothetical at this point. We'll know the multiple when we see the final PPM. If you invest $100,000 on a 5 multiple, generating a $500,000 reduction of your taxable income, and you make $1 million, you would utilize up to 50% of that. That would max out. You take the 500,000 reduction, which is 50% of $1 million, and multiply that against your marginal tax brackets. That's your savings. So
yeah, it's all a math equation here. You can invest 25, and if it was a 5x multiple, you get 125 AGI benefit. But if it's a 4.5, you got to invest a little bit more to get that 250 if you want a 250. If you put 50K, you times 4.5. It's simple math, and I'll share the spreadsheet for those who want that. Thank you, Ashish, for saying that. Given retroactively is off the table, what is your opinion, Michael, on the biggest risk factors to consider here?
Audits, the partnership level audits, and us not doing a good job, letter of law along the way, not looking out for our clients through the work that we do. and running out of money through the audit and legal process, of which we put, again, significant money aside. You're still going to go through the audits. I'd say the greatest risk is disallow of a portion or all of the deduction.
What percentage of the funds are set aside for legal defense?
Have not seen the final PPM yet. I anticipate it being anywhere from 10 to 15% of the investment.
So
And remember, no, please.
So if it's $10 million investment, could be 1 to 1.5 million.
Correct. Anticipating somewhere probably around a $10 million capital raise.
And if that isn't spent, does that get returned to investors or partners? I mean, what happens to that?
So say in this example, you invest $100,000. Approximately 5% of that is going into the audit reserve. We typically put aside about anywhere from 500 to 550,000 in every partnership for audit reserves. It sits liquid in an account. It's a nominal interest-bearing account. It's a money market that sits and waits for the door knock by the IRS. So you have about a 5% ratable share of that amount, assuming a $10 million offering and a $500,000 audit reserve fund. In addition, anywhere from 10 to 15% of that 100,000 is allocated into the strategic fund. That's the legal fund of anywhere, like I said, $1 million to $1.5 million, depending on the percentage and the capital raise. So in that regard, if it's 10%, that'd be $10,000 your ratable share of the legal and $5,000 approximately of the audit. So $15,000. Any unused portion of that through the audit and the legal process is returned back to you, plus your ratable share ownership of the sale of the land, the disposition of land. And that all comes at the end of the audit window or upon adjudicated result to the courts.
And follow up on the question, is there interest on those reserve funds, legal defense funds, and that's sent to investors or partners? When should they expect the first payment on those?
So the audit reserve, again, nominal is probably 0.01%. So don't expect anything there. The investments that we make in the legal fund, the strategic fund, go into, again, private equity, debt, real estate assets, other equities. That all targets a 6% annualized return. And so we raise the money year one. All the offerings of the year contribute a portion into the aggregate fund for the year, the 2022 strategic fund. The next year, we start deploying that capital. So we vetted a lot of investments through the year. We pretty much have a good idea, minus COVID year, what we're going to go into. That year, we had a lot vetted, and then COVID hit and a lot changed. So we had to reevaluate our deployment of that capital. So it typically takes a couple quarters to make all the investments. Last year, we had about $45 million to deploy. That has now been fully deployed in the 2021 strategic fund. So anticipate distributions to ramp up as we make allocations and deploy that capital. So Q2, I just got my statement for 2019 program. Obviously, that's been going on now for 2+ years. I believe 2021 statements reflected the nominal distribution that was consumed by fees. And then Q3, I anticipate that ramping up to actually seeing a positive distribution. So realistically, anticipate Q3 will be the quarter that we're actually seeing distributions.
So what's Greenrock's track record? How many deals have Greenrock done?
So Greenrock started raising capital for our own offerings 2018. We had 4 offerings that year for $23 million. 2019, we raised capital for 12 offerings, $83 million. 2020, we had, I believe, 18 offerings. We raised about $160 million. And last year, right around 20 offerings, we brought about $200 million capital raised. So we have extensive history in mining as well as conserving land.
And follow up on that. Does the vote to essentially conserve, I think as we're referring to, have to happen prior to passage? Does it matter, like if you vote after and you don't get it? What's the cutoff? What's like the ticking time process for this whole thing?
Yep, great question. So typically step 1, we have conversations. You're comfortable with the investment. I send you paperwork, you complete paperwork. In some offerings, the vote is contained within the original subscription document. So you'll vote to conserve preserve, or develop, depending on the offering. Sometimes that vote comes after we've raised all the capital. So in the first example, everything is done at point of completion of the subscription document, investment paperwork for the vote. The second example would wait until we raise all the capital, and then we send out the votes, and then you guys vote. We need to get a simple majority, again, 50.1% voting on any one of those options. Once we achieve that, then we button it up at the sponsor and broker-dealer level, and then we record the deed. Recordation of the deed is the final step. That has to be done before end of year. If it's without Earn Act provisions, that would be around December 28th, or with Earn Act, could be well before that. So it behooves us sooner rather than later to look at this. Again, I don't know if it will pass this year with the Earn Act. That's up to Congress. If in fact it does, I believe this year will be a shortened year. We're going to run out of time a little earlier this year.
What's your best guess?
Just like you, whatever they do in Washington, when they get it all squared away and everybody's needs have been met, they'll vote to pass that act.
And is the tax savings taxable or need to be recaptured in the future? Just like depreciation, which generally needs to be recaptured. Is there any recapture on this?
As far as the deduction,
Yes.
it's a business loss. There's no recapture.
Yeah. So if you donate to charity, same thing, it's business loss, or I mean, as deduction negative against your AGI. What is the operational or accounting overhead? And how much does it cost to get all the audits done? I guess, or to defend against all the audits?
What is the operational account overhead? Also, has the cost to get all the audits done. So at a personal tax level, my accountant charges me, I believe, $400 or $500 extra to file the K-1 with all the documents. They have extra, reporting requirements and printing the 1,600-page appraisal if it doesn't upload the IRS's system. So they have a bit more power hours that they put in. So there's a cost to file the K-1 at the personal taxpayer level. At the partnership level, I believe that 2018, what I just saw in 2019 on my partnership statement, started with 550,000 in audit reserves. It's now down to about 520. So we've spent about $30,000 in the audit. The real cost starts showing up when you litigate. That's when you deploy your lawyers, your accountant, your expert witnesses, etc. Going through the audit is really a paper ordeal. It's an exercise of just sending back and forth requests and documents. They come out, they being the auditors, they come to the office, they walk the property, they verify that we have conserved the land, that the land is as we said it is. So they go through a process as well for the audit. So anticipate, that amount of money to be spent through the audit. And then subsequently with the appeal, tax court and the court of appeals, that's where realistically the bulk of the money is going to be spent. So once we get into that, was there more to that question?
No. When will your deal open up? Your next deal, I guess. And are you confident you're close before expected passing of the Earn Act?
So anticipate final paperwork early next week. So first step, again, we have a conversation. You say, great, Michael, I'm comfortable with moving forward. I send you the paperwork and you complete it. So as we near the end of the year, a point of discussion is this industry raises approximately 80% plus of its total capital for the year in the last couple months of the year. Most people are doing their tax planning later in the year. So imagine how busy it gets as we near the end of the year. Again, this may be a shortened year. Right now, it's probably going to take me a week to 2 weeks to raise the capital. As we get closer to the end of the year, and I think some of you on the call, if you didn't get in last year, again, we just run out of programs pretty quickly. I'll raise the $10 million in a couple hours. It's just how fast it happens as we near the end of the year. I don't encourage that with my clients. You have to have time to evaluate the investment, read the PPM, ask and flesh out any questions and concerns you have. I'm fully available. Once you're ready to make the investment, then complete the subscription paperwork. So if we've got time now to digest and sleep on it, make good decisions, not rush, better. I think that's the way I approach things in my life. As we near the close of the year, it's just going to be, it becomes very, very quick how quickly these close.
Yeah, that's and I see it's all about supply demand as well. In the beginning of the year, there might be a slightly higher multiple as there's less demand. In the end of the year, what I've seen historically is a lower multiple as there's more demand and there's not enough capacity. And so sometimes it's about supply demand, sometimes about investment size as well.
Right.
The investment that would result in deduction goes into Schedule A.
Yep, any carry forward is carried forward to Schedule A.
How many times have you gone through an audit?
2018 is 4 offerings, 2019 offerings is 12. So 16 programs are currently under audit.
Do you anticipate this passing the House or running into any modification?
This being the modification of the 2.5 minus retroactivity. Both sides, the House and the Senate, have both voted to pass this. Now they have to get the final version and vote for the final version. For this provision, again, the Senate Finance Committee has voted 23-5 in favor of moving forward with the provision of 2.5 without the fee or the retroactivity. I don't expect any modification. Again, this has been negotiated from what we understand. And the Congress people that are on the side of the law and the environment, the taxpayer, have said this isn't going to be done if retroactivity is included. And it's got to be moving forward from date the bill is executed.
So in an audit, IRS determines that developed land value, enterprise value, is lower than use. What happens in that case?
So again, my statement is the IRS's current procedure is to put 0 valuation at audit. And it's my own personal thoughts on this. If I had 400 acres of land and a lot of proof, we got about millions of tons of sellable material proven by science, it staggers me that I wouldn't even get $100 valuation. It's just a 0 value. That's the protocol. And again, that forces the tax matters partner on behalf of the partnership to appeal that decision and then subsequently, if necessary, to litigate. So anticipate a low value audit, putting us in that position again of litigation. And this is just the process that the IRS has followed. I don't know what will happen moving forward. If in fact the EARN Act passes with this provision in it, will the taxpayer have a potential target off his or her back moving forward? I don't know. I would say my anticipation is it will continue as it has, and anticipate this going through audit, getting a 0 value, and then us doing our jobs, again, defending our work evaluation with the courts. And it all comes down to the kind of work that's been done, the diligence that's been performed, the money that's been spent with the right accountants, the right attorneys, and the right third parties for due diligence and outsourced reports to make sure that it's objective as possible and conservative as possible and letter of law as possible.
Great. I don't think you have a live example of a K1. Looks like if you haven't, with a land acquisition K1 partnership, like different than any other K1, Michael?
I have one if I can share my
screen. Yeah, sure.
I'd have to hold on 1 second. Let me find it real quick.
Okay, so you do that. James says solar farm is better than BTC mining. Probably, maybe, I don't know. I think it's very related. You can put it anywhere too. So in terms of solar farms.
Okay, I'm ready to share if you are.
Sure, go ahead.
You all see that?
Not yet. Yep, I see it now.
So here's a redacted K1. You'll see that the client invested $325,000 in this example, generating a business loss. This is contribution or charitable contribution of 1.65 million. So this shows up as the business loss here on the K1. Pretty standard K1. This is several years old, so the format may be a little bit different, but this is what we're looking at. And then 13C, is this tracking? Can you guys see this as I'm changing this? Are you still on page 1A?
I'm on page 3.
So you're seeing here the deduction. So we go to 13C. It's a non-cash contribution. at 50% reduction.
Thanks for that.
Got it.
And so what happens if we lose the legal process? Can we get the land back from conservation? Good question.
Lose the legal process. I would say losing would just result in a reduction to the deduction. The partnership still owns the land. The deed has been recorded against title, forever extinguishing the development rights on that land. So the partnership still owns the land. If in fact came to, and I couldn't even imagine it, that the entirety of the deduction was disallowed, and somehow they said it no longer is protected by the conservation easement law, and we undid the deed, we'd then have a parcel of land. More than likely, we'd just develop the land. I don't know, because this has never come about, but the legal process typically would be an adjudicated result of a reduction to the deduction, of which again, the partnership and the partnership level would cover any deficiencies with any remaining reserves. And then any bonus or surplus would be distributed to the shareholders or partners. Any deficiencies would be subject to an amended K1, of which you would amend your tax return.
Any scenario where we see a capital call?
Great question. Again, partnerships in the past may or may not have put aside significant resources. They may have done shoddy work. Who knows? I don't know. With us, great work along the way, lots of money put aside, all with the purpose of never sending our partners a capital call letter or a laydown letter for the IRS. Again, we're going to rigorously defend our work and our valuation, and we have a lot of money put aside to do so.
Nice. So you said, I think you said 3% residual of the land. So at sale at a 40 million enterprise value could be 1.3 million returned to LPs pro rata, plus any unused portion of legal and audit defense funds also pro rata. Is that correct?
So remember, enterprise valuation is the land as developed. The purchase price of the land is significantly less. So if we bought the land, say for $1 million, we sold it for 3% or $30,000. That's what we would participate in, the 30,000.
Yeah. Yeah, I think the overall is, I would expect the vast majority, I'm not sure what that percentage would be on the tax savings, and it's fairly immediate. Everything else is nominal at best.
Yeah, realistically, the anticipation of a windfall on sale of the land, don't expect that. It's going to be a nominal amount.
Yeah.
And that's going to come years later. Could be 3 years, could be 5 years, could be more.
Yeah.
Realistically, again, if the land is voted by the partnership to conserve, the majority, and I say significant majority of your investment return is coming first year.
Yeah. Try to get it. I mean, you can get, if you're investing at $50,000, $500,000 AGI, you're going to get, more than 140% return on investment. It's 2.4x basically. So basically we're getting it, in a fairly short order too. It's not like, waiting 5 years or, 10 years for a deal to materialize and sell. You're getting it right away. And if you tax plan well enough, you might not even have to pay taxes. So you might get it like so immediate, like the IRS, so incredible. That's probably why they try to.
I have a lot of conversation with clients. This is my own personal tax and investment strategy. I don't spend that money. If I save $100,000 this year because of this deduction, I invest that $100,000. And so this is essentially found cash that otherwise I would have written a check out of my savings or checking account. This is coming out of reduction of a tax bill, a tax obligation, of which goes into investments. So my consideration is, if this is adjusted down the road 5 years later and I have to give back 20%, I have the money, because that was just tax that was due anyway, time value of money. I got to use that money for 5 years earning a rate of return. And if I do this every single year under that investment style, there's significant wealth that can be amassed.
Yeah, it's great. I mean, that's why I like to discuss it with investors. I think it's not only saving you guys money, but hopefully money to invest in our deals or other people's deals.
Sure.
Just think like an investor. Can you elaborate on the level of distribution expected for the investor, and these distributions are funded. How these, I think you touched on that at length. Do you want to talk? Is there anything addition to add?
Now, again, a portion of your investment is going to be allocated into the audit reserve, anywhere from 500 to 550,000. I'll know that number when I see the offering documents. And anywhere from, say, 10 to 15% of the investment goes into the fund. That fund we invest in, it's internally managed. We invest again in various vehicles that throw off cash flow. So the level of distributions, we target a 6%. It's not stated, it's a target. We've hit that number, I believe, after fees on all of our 2018, 19, and 20 offerings. In 2021, again, we've made the investments. I believe we are fully allocated. So again, the target is a 6% annualized return. And that is in addition to the AGI tax benefits, yes.
What percentage of past deals have been developed, I guess, instead of preserved?
1.
It must have been an interesting partnership. You mentioned that this may pass at the midterms. So the time frame of passage is potentially November or December. So it could be before the end of the year.
Yep. John, great question. Yes, we're going to have multiple offerings. We're in the stages of closing on land and due diligence. These offerings from start to finish, once we identify a parcel of land and we tie that up with the seller in contact with contingencies, it takes about 6 months to do all the due diligence, get your PPMs drafted, get everything buttoned up before I have a final PPM registered with the SEC and raising capital. So these are very labor and financial and time intensive. So we're putting these things together as we speak. I anticipate having 3 or 4 offerings in addition to this one. So again, we're going to run out of time or offerings. It's just how this industry works. I don't know what the time will be this year. This is the point of our discussion. Could be sooner, could be later. But the anticipation is we're going to run out of either time and or offerings.
Great. And so Sunit, final question, unless someone has any more. Max investment. Okay. Max investment is based on 50% AGI. Well, it's not really max investment. It's based on it's the max deduction is 50% of the AGI. So you could invest more and get more deductions, but you can only take 50% of that in that 1 year, correct? And then you can carry that forward for the next 15 years, although you probably want to take it the next year because time value of money.
Correct. Yep. No limit. The only limit to the investment is what I have available in the offering. So if I got a $10 million offering and I'm up to 9.5 million, your allocation cap is 500,000. That would be the max investment. You can invest in another offering, but the max, what we focus on is the max deduction. And that's the 50% AGI first year or any year, excuse me.
Do you want to recommend your accountant? Anybody have any good accountants?
Yes.
Okay, so talk to Brian, talk to Michael. Michael, after this year, after this earn-out, what are you gonna do?
So we have many businesses under our umbrella. We've been very successful in mining and other businesses. So anticipate something very cool coming next year. We're getting into solar development, solar tax credits. We've got some other cool development options. There may be some mining options, actual gravel mining options. So small offerings to say thank you to our current clients. So anticipate something cool coming next year. This year, we're focused on development with potential, obviously, pursuant to shareholder vote of conservation.
A few more questions came in. Did one last year. Do I need to go call Michael again? Apparently, that wasn't a very pleasant experience. Can I just get the PPM via email and sign?
I didn't see your part of that, but I can. Yeah, I still need to talk to you briefly. We'll just have a quick conversation. So yes, please reach out to Ryan or myself directly.
And who is the sponsor for this? Greenrock's page says they're no longer sponsoring easement programs.
Yep. So the same company that sponsored these last year's Trimera, they actually buy deals from Greenrock. And Greenrock made a decision this year not to develop with conservation easement option. There's a command decision made at Green Rock's level. We're still mining. We're still doing a lot of work in mining. So this is being marketed through Trimera, same company that you worked with last year.
Great. So they will resign themselves to calling you. So just take it as a hint, Michael. Okay. Thank you guys for all your questions. We went an hour 25 for more, actually. Really appreciate your time, Michael. Appreciate everyone's
My pleasure.
attention.
Thank you.
Again, please reach out to Ryan. I think that'll probably be best because I know that Michael is very busy, and Michael will make sure Ryan will make sure to connect you guys with Ryan. Sounds like you have an offering coming next week. And my advice is to learn how to. My advice would be to take your time, think about it. I think it's very interesting. I know historically I've done it, other investors have done it to great success. And Michael, any parting words?
Last question from anonymous attendee.
Okay.
It's coming. My last words, thank you very much for spending the time this evening. It's a long discussion. I think it's warranted. This is a very interesting code section within the IRS code, a very important code section. Again, the only mechanism to preserve land, which is ethically very important in this country. And so knowing that this is the last year for the most part, if the IRN Act passes with this provision, please understand that you have this in the tax code this year to utilize it to your benefit and to the benefit of the environment. Ooh. And any questions that you have, please reach out. Again, if you're a current client, guys, I'm very comfortable just reaching out to me directly. If you're not a current client, please go through Ang and Ryan, and they will connect you with me. We're going to get on a phone call, a Zoom call. You'll ask questions. We'll flesh it out. I'll ask you some questions. Make sure you understand the investment that you're getting into, and then we can send paperwork and just go down that road. So please feel free to reach out at any time, either to Ryan and Ang or myself.
Thanks, Michael. Two last questions. Would the first deal, meaning the next deal, be cheaper, meaning higher multiple than the last one, if there's the subsequent one?
Yep. So I can't speak directly to anything specific on the offering until I have a final PPM. That's the document that is finalized, broker-dealer signed off on it, and the SEC it's registered with. So my anticipation is by multiple. I don't anticipate it being higher or lower through the year, but I'll only know that once I see the offering documents.
Great. Yeah, historically I've seen that's the trend, but obviously deal by deal. And final question, and I'm not going to ask, would you recommend your own mother to invest in an easement this year?
Yes.
And it makes more, $120,000 and it's a credit investor. Might make sense. Thanks, Michael. Have a good night.
Guys.
Take care.
Have a great evening. Take care.